Debt fuels billionaires. But if you're not careful, it can wreak financial havoc. If you want to master debt as a strategic tool, you need to be financially savvy and willing to take risks. Use it wisely, and it can boost your finances. Abuse it, and it can drain it like rapid fire. This is a risky strategy with the potential for big rewards, but also severe losses, especially for those without enough backup funds if things go wrong. It's important to be cautious. The masters of debt utilization. Members at the pinnacle of the rich list summarize debt as elegantly as a chess grandmaster visualizes the board. Every loan strategically targets unlocking new wealth creation opportunities as they expand their financial empires. Peel back the layers of their financial engineering wizardry, and 6 underlying principles emerge. They build empires. Using leverage, much like John D. Rockefeller acquired smaller oil companies with borrowed money to build his Standard Oil empire. Today's financial magnates aggressively utilize leverage to consolidate their grip on key industries. Elon Musk may be well known for his visionary leadership, but his empire building also leverages debt tools, including mortgaging his existing shares to finance new acquisitions. As his empire grows, he keeps tight control of finances to ensure debts remain manageable, never overextending his risk exposures across his web of companies, including Tesla and SpaceX. The Rockefellers of today methodically assess target companies undervalued by public markets. They deploy financial modeling expertise, quantifying worst-case downside scenarios before determining prudent debt levels and negotiating financing with banks or private capital partners. After the acquisition, they install operational improvements, driving up company valuations, refinancing earlier debts at lower relative burdens due to those rising equity cushions. When timed well across industry cycles and executed with ruthless efficiency, the strategy compounds wealth exponentially over time. But mistakes can carry harsh penalties. Overpay for acquisitions or fail to integrate operations quickly, and the debts become crippling burdens instead of catalytic accelerants. Tread carefully. Building empires using leverage, as described in the passage, is often associated with high-risk strategies that may not be suitable for everyone, especially for working-class individuals and minimum-wage earners. However, there are still principles and financial strategies that individuals with limited resources can adopt to improve their financial standing. Here are some suggestions. Invest time in acquiring valuable skills that are in demand in your industry or the job market. Attend workshops, online courses, or community college classes to enhance your skills. This could include acquiring technical skills, certifications, or soft skills that make you a more competitive candidate for higher-paying positions. Create a monthly budget that clearly outlines your income and expenses. Allocate a portion of your income towards building an emergency fund. Tracking your spending helps identify areas where you can cut costs. The emergency fund provides a financial safety net, preventing the need for high-interest loans or credit cards in case of unexpected expenses, ultimately avoiding the debt trap. Start investing in low-cost, diversified investment vehicles, such as index funds or retirement accounts. By consistently investing a portion of your income, you participate in the growth of the financial markets over time. Diversification helps spread risk, and low-cost options minimize fees, ensuring more of your money is working for you. This approach aligns with long-term financial goals and minimizes exposure to risky leverage strategies. They minimize liquidation events for key assets. Have you ever wondered how billionaires actually fund their lifestyles without relying on salaries like the rest of us? Visionaries like Elon Musk leverage their vast assets, borrowing against their stocks and shares, rather than liquidating them and triggering large tax bills. By keeping their ownership and avoiding immediate taxation events, their net wealth continues to balloon over time. They tap lines of credit collateralized against those shareholdings to fuel lavish lifestyles most of us fantasize over. However, such strategies are not without risks. Severe market corrections triggering margin calls could force them to sell key positions in temporarily depressed markets. However, the wealthy build sufficient capital buffers to enable them to soak up these periodic shocks when volatility spikes. By avoiding reactionary selling during transitory price weakness, they position themselves to maximize their long-term compounding by minimizing disruption events. Now, let's distill this concept into 3 actionable steps that individuals with more modest means can consider. Strategic asset utilization for financial flexibility. instead of immediately selling valuable assets. Explore ways to leverage them without triggering significant tax events. If you own appreciated assets, such as stocks or real estate, investigate options like low-interest loans or lines of credit that use these assets as collateral. By doing this, you can access funds for specific needs without selling the assets outright and incurring substantial taxes. This approach maintains your long-term wealth growth while providing financial flexibility. Building a financial buffer for market volatility. Establish an emergency fund or financial buffer to cushion against market fluctuations and unexpected expenses. Even without vast assets, creating a financial buffer allows you to weather temporary market downturns or unforeseen financial challenges without being forced to sell investments at unfavorable prices. This buffer acts as a safety net, preventing reactive selling during market dips and enabling you to hold on to assets for long-term growth. Strategic, long-term investing and risk management. Adopt a disciplined, long-term investment strategy while being mindful of risk management. Focus on diversified, long-term investment plans aligned with your financial goals. While you may not have the extensive assets of a billionaire, managing risk through diversification and avoiding overly speculative investments is crucial. A well-thought-out investment strategy minimizes the likelihood of being forced to sell assets during market downturns, allowing you to capitalize on compounding growth over time. They aggressively utilize real estate leverage. The tycoons obsess over real estate. Using mortgages provides immense leverage, while interest payments are tax-deductible. With enough scale, rental income can fully offset financing costs, opening access to properties well beyond their immediate capital capacity. They masterfully watch debt ratios across their portfolio to keep overall risks acceptable, while aggressively adding new properties when credit markets loosen. Imagine buying a $5 million building with a 20% down payment. You invest $1 million upfront, controlling the entire asset. If a few years later it appreciates to $6 million, that $1 million generated a $1 million profit, a 100% return despite only 20% of value initially out. Magic. But don't forget, leverage magnifies risks too. A 20% price decline would erase your equity completely, with the bank now holding all the cards. The real estate moguls combine leverage with diversification, spreading their risks across cities and sectors. They stress test their holdings across interest rate and rental demand scenarios through industry cycles, allowing safety buffers. And when possible, they secure fixed-rate financing, insulating their costs against rising rates. But marketplace shifts can catch even giants off guard. Global financial crises triggered widespread turmoil lasting years with severe cash flow strains for over-leveraged owners. Never forget, easy credit fuel booms mask genuine supply and demand realities. Time market peaks and troughs incorrectly, and the leveraged pain exceeds the leveraged gains. Pay attention to those leading indicators. How can we do this? Explore real estate investment opportunities with the use of mortgages, considering properties within your financial capacity. Look for properties where you can make a reasonable down payment while using mortgage financing to control the entire asset. This allows you to benefit from the property's appreciation while minimizing the initial capital outlay. However, be cautious and ensure that the financing terms are favorable and the investment aligns with your long-term goals. Diversify your real estate investments across different cities and sectors to spread risks. Avoid putting all your real estate investments in one location or type of property. Diversification helps mitigate risks associated with local economic downturns or sector-specific challenges. Additionally, stress test your portfolio by considering potential changes in interest rates and rental demand, ensuring your investments can withstand fluctuations in the real estate market. Be cautious with the amount of leverage used, and consider securing fixed-rate financing when possible. While leverage can magnify returns, it also amplifies risks. Carefully assess the debt-to-equity ratio and avoid over-leveraging, which could lead to financial strain during market downturns. Whenever feasible, secure fixed-rate financing to protect against rising interest rates, providing stability to your financing costs over the long term. Remember that real estate investment involves inherent risks, and it's crucial to conduct thorough research, stay informed about market trends, and make well-informed decisions aligned with your financial goals. Additionally, be mindful of economic indicators and market cycles to avoid potential downturns and capitalize on opportunities. Part 4. They make big bold bets. What exactly motivates a multi-billionaire to keep aggressively leveraging their empires? For some, it becomes an obsession to keep raising the stakes, hunting legendary payoffs. Think corporate raiders or that upstart rival seeking to dethrone your dominance? Merger mania and private equity buyout specialists look for underperforming companies where radical overhauls can unlock startling growth and competitiveness. And their weapon of choice, the debt-fueled leveraged buyout. Imagine buying a company after raising loans worth 90% of the acquisition price, using the target firm's assets as collateral. Install upgraded executives while right-sizing cost structures and incentivizing cultures around accountability. If successful, company valuations multiply several times over. Even 20% ownership provides immense payoffs, now controlling a beast multiple times larger than the original acquisition costs. However, they fail to reignite growth, and the debts become time bombs, steadily eating into equity buffers. While reserved for the big league players like private equity funds and reputed activist investors, small businesses also regularly change hands using leveraged buyouts. The math can accelerate growth for the right buyer in the right sector. But remember, things can go wrong, even with the best due diligence. The leverage magnifies risks of overpayment if new competition disrupts that sexy growth story. They keep liquid. Using credit, wealthy individuals enjoy almost unlimited flexibility, keeping liquid without needing to immediately sell existing investments. Billionaires simply borrow against their assets, using them as collateral for lines of credit or customized financing arrangements with banks. The benefits stretch far. They may pledge their investments while keeping upside exposure, tap credit lines only when deploying capital into promising new deals, while keeping their costs tactical rather than carried permanently. And no disruptive taxation events or transaction fees from periodic liquidations to free up capital. But in cases of financial duress, the banks won't hesitate to seize assets sold in fire sales to recover their loans. Leverage grants them immense flexibility in managing temporary cash shortfalls. They may negotiate credit facilities, securing attractive terms from banks competing for their patronage. Compare that to distressed credit card debt, attracting 20% interest rates annually. But flexibility necessitates careful governance. World-class wealth managers monitor their liquidity and leverage ratios continuously, ready to unwind positions nimbly to avoid damaging margin calls. Liquidity presents opportunities. Vulnerability during distress introduces unwelcome risks. They utilize inflation to minimize real debt burdens. Here the magnates rely more on logic than financial engineering. When debts are fixed rate and long-term, inflation steadily chips away at the burden of repayment over time. Meanwhile, their assets appreciate ahead of inflation due to their scale. This combination concentrates their ownership of real wealth, while obligations become relatively smaller over time. Imagine financing stable assets like real estate using 30-year mortgages. As inflation averages even 2 to 3% annually, the relative costs of repaying those obligations declines every year. Yet rentals and property appreciate closer to historical asset inflation of 6 to 7% yearly. Within a decade, those initial credit risks fade substantially without hampering wealth acceleration. Timing matters hugely, though. Financial historians emphasize cycles lasting decades, with occasional generational resets. While inflation has trended downwards in recent decades, market shocks trigger periodic volatility. When clinching financing terms, assume inflation-inflicting scenarios, and assess resilience accordingly. Risks in plain sight. The wealthy fathom intricate debt dynamics expertly, relentlessly engineering higher returns without succumbing to distraction or panic during unexpected crises. But these 6 wealth escalators carry immense downside risks if managed amateurishly. As a reminder, acquisition sprees require extensive modeling and operational oversight. Debt balloon payments without cash flow cover can crush even mighty empires. Borrowing against stocks risks forced liquidations if share prices crater. Preserve ownership positions using reasonable balance sheet, gearing without overextending. Real estate lending excesses may drive unsustainable price appreciations, enticing over-leveraged owners. Model realistic scenarios, not just rear-view trends. Leveraged buyouts require precise valuation and turnaround capabilities. The newly acquired loans must remain serviceable after deal fees and buffers. If pledging too many assets as collateral during boom times, investors won't survive margin calls in eventual downdrafts. Moderate leverage remains key. Long-term fixed-rate debts offer mathematical advantages against inflation. But if business fundamentals weaken, the real burden caused by debts can still sink balance sheets. The appeal for ordinary investors, reviewing the masters flaunt their sleights of hand with such dazzling success, accentuates the wealth gap dishearteningly. But before abandoning all hopes of narrowing that deficit, recognize that several techniques suit adaptation for ordinary investors too. We may lack their scale, but math still enables reasonable wealth acceleration in our niches. Tap home equities judiciously. Home owners gained over $6 trillion in equity globally in 2021, alone as red-hot housing markets stretched affordability. Want to invest amidst record prices without immediate capital? Follow the tycoon playbook using debt prudently. Mortgaging a portion of your real estate equity frees capital for diversifying into other assets, potentially offsetting inflation better and spreading risks. Income generation smoothens financing costs. If managed astutely, net wealth should outpace debt servicing burdens, but safeguard against reversals. Housing corrections historically averaged almost 30% peak to trough during even short-lived bear markets, so moderate mortgage levels limiting risks of negative equity, and account for job losses or interest rate spikes in cash flow planning. Learn about investment, leverage, exchange. Traded funds, spanning assets from gold to tech stocks, now offer leveraged versions. For short-term tactical traders, 2x daily leverage proves a formidable wealth accelerator when timing markets correctly. But left unchecked, volatility decay crushes returns mercilessly. The lesson remains universally relevant. When used astutely, leverage amplifies gains. When abused without risk control, amplified losses cause severe wealth destruction. Fund business ownership, dreams. Tapping modest business loans to acquire a local franchise bears merits for ambitious entrepreneurs. With adequate cash flow modeling and lean operations, such small leveraged buyouts provide pathways for business ownership without requiring immense capital outlays up front. Assuming sensible purchase prices and realistic growth assumptions, debt kickstarts viable enterprises and the equity value compounding that follows. Either brilliant or nightmarish, depending on its use, debt remains the most polarizing wealth accelerator. Mastering its nuances, and debt magnifies fortunes efficiently. Underestimate its powers and even titans stumble. Managed judiciously, integrates into ordinary wealth planning too. But disregard its risks and leveraged nightmares manifest suddenly. The margins for error prove unforgivingly narrow.